forward our market chatter then and introduce on the show Samit Vartak of SageOne Investment, who really needs no introduction. Samit, thanks so much for joining us today on ET Now.
My pleasure.
Every bear call, every comment on, okay, look, the market's looking a little expensive, valuations are extremely high compared to historical trends. Every comment like that has been defied and how by the market, even as we sit at yet another record high, 17,570. Where do you think the market is deriving this bullishness from?
Yes, it's natural that, after such a big run, small cap index having almost tripled since March, and because of recency bias, because markets went through a pretty tough phase before pre-COVID itself. So it's natural that everyone do feel little jittery about markets. And if you look at historically in the last 30 years, out of those 30 years, 20 years, we have had at least a 15% correction, right? So we have had now 17 months where there hasn't been any such correction. Almost like a smooth upside that we have had. Right? But I find the fear to be pretty genuine, and one has to be cautious in the market. But I think one of the factor which is underappreciated in the market is how the cash flows are and how the balance sheet is, right? So when you look at the P multiple, of course, it looks at the highest level that we have seen in history, about 30 times trailing multiple. I'm not talking about Nifty 50, but say the top 500 companies, and their median P multiple is around 32 times, which is pretty high. Even in 2008 or any of the last peaks, we haven't gone to those kind of levels. But then if you look at the cash flow, right, the enterprise value to cash flow, one is the debt has gone down. So when you look at, and that has gone down because of the cash flow that the companies have generated. And most of the companies have taken a call that we just want to be debt free. We'll be surprised how many companies have become debt free in the last 17 months. And that's where when you look at the cash flow multiple, which is enterprise value to cash flow from operations, it's at about 15.8 times, which is below the historical average over the last 20 years, which is about 16 times, right? Now compare this with the 2018 kind of peak. It was at about 25 times, and even in 2008, the peak was about 25 times. So from here to reach that kind of peak, it's still 60% away. So many a times, and at the same time, just look at the balance sheet. The debt to equity ratio today is at 0.16. 0.16, we have never seen in India's history. And then the third thing I think one has to look at is how do the cash earnings yield compare against the bond yields. So the bond yields today for India, 10-year GSEC is about 6.2%. And when you inverse the enterprise value to cash flow from operations, which gives you the cash yield, it's at about 6.3%, which is higher than the bond yield. Rarely in India's history over the last 20 years have we seen higher cash earning yield than the bond yields. And if you compare this with 2008, the bond yields were at 8% and the cash yield was about 4%, 50% discount. And you look across all peaks, whether it's in 2000, 2011, 2017, the earnings yield used to be at least 30 to 50% below the bond yields. And that also gives you an indication that, relatively, because after all, it's all relative valuation, right? If everything else has become expensive, it has to be considered against that. And relatively speaking, it's not that worrisome in terms of the valuations.
Very interesting point. So instead of looking at valuations from the P&L perspective, you're looking at it from the balance sheet perspective. And yes, balance sheets have been repaired very well over this last one and a half year. Cash flows have improved. So if that's the case, Samit, why would you still be a little cautious on the market? Would it also be because not all sectors have managed to repair their balance sheets, and would you rather stick to those sectors then where you have seen good improvement, good reparation in balance sheets?
Yeah, I think the balance sheet repair has happened across sectors, whether it's commodity stocks, material stocks, real estate stocks, and anyways, consumer and those kind of stocks never really had any issues. So I'm just being a little cautious because of the kind of relentless rally we have had. And, there is high probability that someday we will get that 15% correction, which has a 2/3 probability, in a year. And that's the only reason. I mean, I am in the long run, if you are able to take that kind of a correction, 15%, because a lot of people do fear such corrections. Because, if the market corrects by 15%, a lot of the stocks in the mid and small caps can correct double or even more than that. I think that's the only reason for caution, but we don't know when this correction will happen. Whether it can come, it can come next week, or it can come 2 years, 3 years down the line. There is no way to predict that. So it just there are certain pockets, which we already all know in terms of IPOs, and there is frothiness in some of those pockets, and that that does give you some reason for worry. But when you look at from a longer term perspective, from a 2 to 3 year perspective, I haven't seen India's wheels, in terms of the government finances, the consumer finances, the corporate finances, as well as the export potential, all, in a favorable condition, all at the same time. And this is probably the first time I'm seeing all of that happening. I mean, just consider that, corporate balance sheet with, such low leverage. I've spoken to so many companies who are planning to double their capacity over the next 3 to 4 years. And almost all of them do not want to take any leverage. They are all just relying on their internal approvals, so, and it's unimaginable how much strength a really strong balance sheet gives you, because you cannot be pressurized by any customer, any vendor, if your balance sheet is strong. And that's where I do not really fear a crash kind of a scenario when the balance sheets are so strong. Look at the government, so government, who would have thought that, India would be collecting taxes, which is beyond the budget for this year, right? I mean, the GST collection as well as the income tax collection is almost at all-time high and well beyond anyone's expectations during COVID times. Also, look at the consumer. See, majority of the population of India, would 95% would be mostly spending on the necessity items, so that kind of consumption doesn't really change much, buying your toothpaste or, most of the necessity items. But if you look at the top, 2-3% population, or, max 5% of the population, their salaries have gone up. I was just looking at the June quarter salary levels. On an annualized basis compared to a year ago, the salaries have gone up by 1.3 lakh crores. That's a pretty large sum, so salaries have gone across IT. I speak to pharma companies, and they are finding it difficult to get employees. And if they want to get employees, they have to pay 30-40% higher. So that's pretty strong. And government finances are strong. That means that, they will probably meet their infra spending of 1.4 trillion, which is higher than what the US has announced. And we speak so much about the US infra spending. So I feel government finance is strong. They should be spending. Consumer is strong with salary increases. Plus, just look at the wealth increase of just in the last 1 year, not even from March lows. The overall market cap of Indian companies have gone up by 100 lakh crores. And that is, 1.35 trillion dollars. And out of that, 30% is probably owned by, the non-promoters or the Indian public through mutual funds or direct investments. So that's 30 lakh crores. 30 lakh crores is not even the budget of India for the entire year. So, that's the kind of wealth creation, and that will aid consumption. And we all know about, China +1 and that kind of trend. The environmental clearances today is at, almost all-time high. That gives an indication, leading indication that there is big capex boom coming up. There are companies who are wanting to spend, and yeah. So I mean, there are many factors which gives me much more confidence today, where out of a crisis, the balance sheet of everyone, government, consumer, corporate, plus foreign exchange reserves are probably in the best conditions.
Right. I can see the glint in your eye when you talk about, what corporates and the health of India in balance sheet is as an investor. But Samit, as a market watcher, it's been a parabolic move for the markets. I mean, the Nifty alone has risen 10,000 points since the pandemic lows. We've had virtually no correction in the last 17 months. I also want you to alert our retail participants and viewers who are watching this show that even amidst a bull market, one can see steep corrections. In your own history of tracking the markets, help us understand if indeed a correction comes, which a part of the market is awaiting, how steep could it get for a market like this?
Yeah, I mean, see, I call a crash to be probably more than 25% drawdown, right? But even if you look at like the last real bull market we had was from 2003 to 2007. Probably we had at least a 15% correction almost every year during that time, sometimes twice a year. So I mean, 15 to 20% correction is possible even in the best of the bull market. So one has to be ready for that, and probably a lot of new investors may not have seen it. But I feel even the newer retail investors are pretty smart. They are pretty well read, So I mean, we shouldn't underestimate them. They are pretty much aware of the risks of the stock market, and there's too much of literature and talk available, for retail investors today, which probably wasn't there in the previous cycle. So I think the retail investor today is much more educated and well aware of the risk. But yes, when you actually go through that correction, whatever your theoretical knowledge could be, but I mean, everyone will probably learn through that experience. And I feel it's needed for the market. The markets have to correct at least that 10-15%. That keeps everyone in sanity, and generally those are the shakeouts which are needed, because that generally takes out the weaker players, and you need the market to stand on a strong foundation, because if you keep on going up, it is supported by lot of weak investors, and then the more you let it go up, the bigger will be the crash. So actually, a good 10-15% kind of a correction would be really welcome.
Absolutely. That sort of shakes off the weaker hands and the froth does come off when we see a correction in this bull market. But that said, what is the real fear of the market actually turning tide, Samit? Would it have to be an event around the interest rates? There was a lot of heightened talk around the last Fed meet about a taper tantrum. Fortunately, that didn't quite happen. The Fed has also sort of kicked the can down the road. Same can be said about our own central bank. Given the last CPI print, it seems like RBI is in a comfortable spot with regards to inflation and is going to continue to be in an accommodative stance. But do you think there is a big overhang that when interest rates rebound or turn tide, so would the markets?
Right. See, that's a general perception. But, in my recent memo, I presented a table which shows for the US market, how the S&P 500 did when the Fed was increasing rates versus the Fed was decreasing rates. And across cycles, it was a very direct relationships. So the up the rising Fed rate cycle also results in actually good results for the S&P 500 because it's natural, right? Most often the Fed increases the rates when the economy is doing well. Generally economy doing well reflects, in moderate inflation. And if that is the case, which seems to be the case even this time, then the markets are generally positively correlated. So it should do well. So in the short run, you could get shocked just because of the news that would come out. But when you look at that cycle from the bottom to the top of the interest rate cycle, the markets tend to do really well, and seems logical to me, because in a rising interest rate cycle, typically the competition to equities are the bond, the largest competition, and bonds would lose value in a rising interest rate cycle. So typically, a large investor would want to over allocate to equity rather than to the bond market. So it seems logical. And yeah, but I mean, there will be shock suddenly if beyond expectation the Fed announces a taper which is much higher than what the markets are expecting. But it should not really matter in the entire cycle. I think the risk comes in when the Fed rate cycle peaks and the downtrend starts. That's when the markets really correct. Across history, if you see, rising interest rates are generally good for the equities market. It's when they peak that's where the real risk of crash comes in. I feel we are nowhere close to that. Probably at least a year, 2 years, 3 years away from that, because we don't know how long this tightening cycle will last. And I mean, you are right. The markets have gone up, but if you look at a longer term historical perspective, last 10, 11 years, our dollar annualized returns probably are just 3 to 4% compared to like 15% for the US market. And just look at, I mean, a lot of broader markets have, broader market has gone up much more than the Nifty in the last 17 months since COVID. But you also have to remember that the Nifty small cap index from the peak in January 18 to the bottom in March 20 had fallen by 67%. So just to recover that loss, it had to triple. So the small cap index was 9,700 around that level in Jan 18. Today probably is at near 11,000. So which is almost flat in a 3.5 year period. So you got to put this run up in a historical perspective, and we have a lot of catch up to do to catch up to a longer term return profile of India.
Samit, I know that you have realty, building materials. These are some of the names that you are bullish on. We have been seeing for the last couple of months a good amount of pickup in real estate sales. Some of it also because of the low base, but largely because consumers are coming back in a big way. Housing finance rates are so low. Samit, is this one of those 2008, 2009 moments for the realty companies where we had share prices as well much, much higher than even what they are right now?
I would think so. I mean, generally real estate goes through long cycles, and we have had probably 8-year cycle where the prices of real estate in across most cities haven't gone anywhere. And during that time, probably the salary levels of the real customer, which is mostly in the top, that 5% population that I spoke about, their salaries just in the last 2-3 years have doubled, and probably over the 8-year period, more than that. So flat prices, salary levels, going up multiple times. At the same time, the interest cost or the mortgage rates have gone down from 10% to probably 7% today. So that's 30% sort of reduction in EMI. And it's natural that during COVID, because of working from home, schooling from home, people are looking for bigger houses. So there is demand in most cities like Bangalore, Pune. Again, it will be driven by IT, employees, maybe pharma, a lot of financial services employees who have done pretty well during these times. The buying has, I mean, as you said, picked up. The inventory level is at the lowest level in many cities in the last 10 years. And, generally that's how the cycle works. First, the inventory is depleted, and then the stock, the real estate prices start going up. And as the prices start going up, even investors start coming in. Initially the buyers are mostly the ones who really need a bigger flat or a new flat. But the followers, which are the investors who basically want to make profits out of the rising prices, they generally are even higher or more than the actual users of real estate. And I think that kind of a cycle, has had a good start, and all ingredients are in place. So, I mean, see, you can only base your investment decision based on facts. Even the market levels and all those factors that I said, those are based on facts, right? Those you would uh, think they would last for 2 years, 3 years, 5 years, 10 years. No one really knows, right? Because you can't predict. But you got to be ready that your thesis may not, because always the statistics may not have a similar history of how it worked out in the past. But based on present conditions, I really feel positive that real estate should do well, building materials should do well, because look at, as I said, environmental clearances are at all-time high, and driven by probably PLI scheme. There is, as I said, there are so many companies who want to double their capacity, and it's a leading indication. So real estate, factory construction, warehouses construction, airport construction, government spending on a lot of infra projects should be good for the building material segments. So I'm positive on real estate, building material, export-oriented themes, whether it's specialty chemicals, pharma, APIs, CRAMS, or IT segment across the board. I feel this is going to be broad-based rally. So even though I am positive on these, there are a lot of sectors which could do well. It's probably just important that you are in the market. There will be many segments, probably even commodities, across the board could do well. This is not probably going to be a stock picker kind of a market. A bull market generally is, you just need to be there rather than it's not going to be a selective market. This is going to be my expectation is that this is going to be a broad-based kind of rally.
Like a retail investor and ask you, have we already seen the best, or is it only in hindsight that we realize what a great bull market we were part of?
Yeah, that's the trickiest part of any bull market, because as we know, it's almost impossible to predict the way markets would behave. I mean, who would have thought that post-COVID we would have such a rally, when we thought it was one of the biggest event, worst event in our lifetime. And look at the markets, probably one of the best returns in our lifetime. Who would have thought that after Trump winning the presidential election, there will be such a big rally? People were fearful of that. So predicting markets is a very difficult thing to do, and that's where timing the market is going to be very difficult. But you can't miss a bull market. I've spoken about this multiple times, that if you look at last 40 years of Sensex history, the Sensex probably has gone up by more than 250 times, and most of those returns are from the best 1% days, right? So most of those best days will be in a bull market, so you can't afford to miss out on those days. The remaining 99% of days is returning zero returns, right? So, and that's the problem with markets. The market returns are very concentrated. You will probably make most of your money in a short period of time, and then go through even longer phase when there is meager returns. And that makes the timing really difficult. And market is a very dynamic mechanism. It tries to predict a lot of things well in advance, right? So you can't always link it just to what's happening around you, because there are too many thinkers around you, and they're trying to be ahead of the game. So markets will be already well beyond the levels when the economy reaches that kind of a level. So yeah, I mean, it is a tricky situation. That's where it's generally good to be part of the market when things are normal or nowhere near froth. Maybe I think timing helps if you're able to avoid the crash. When there are all kinds of signs of frothiness, which I don't see at this time.
Relieved to hear that, Samit, and always insightful and great to have you on the show and speak with you.
My pleasure as always.
Thanks. Okay, that's the word coming in from Samit Vartak, a whole lot of insight.